Welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Sam Lau.
Hey.
Sam, it's 10 a.m. Pacific time here, November 8th. It was a quiet week this week, I'd say. Well, what do you think?
Quite weak in the markets, maybe. A couple other things going on this week. But from a market perspective, it does seem pretty quiet.
Yeah, it seems like people are, I would say, still maybe in shock or still kind of trying to process the information all the information that we've had this week. So it does seem pretty quiet. But why don't we get into, as Jeffrey likes to say, the bloodless verdict of the market and see what's going on.
Yeah, well, the equity market seemed to like what transpired this week. So starting out with the S&P 500, that's up almost 5% on the week-to-date basis. I see it up 4.7% right now. Leading the charge here is Elon Musk's, driving. Looks like it's driving consumer discretionary up right now. It's up over 7% on the week, by far and away the leader sector right now. Tech, industrials, and energy, though, not too far behind. Let's throw in financials there as well. Those are up almost 6%, but not quite there yet on the week, just a little bit shy, but certainly a strong performance nonetheless. In fact, when I look across all 11 sectors here, I just see a positive print across the board. The laggards here are going to be consumer staples and utilities, not quite making the plus 1% return for the week-to-date basis. So we'll see what the remainder of the day holds in store for those two sectors if we can get everything up over 1% there. But certainly a strong week for the U.S. equity market when we're looking at the S&P 500. But taking a look a little bit deeper here across various ways to cut the equity market. If you look at the Russell 1000 versus the 2000, kind of a indicator of large cap versus small caps. The small caps are up big. They're up over 8% thus far on the week to date versus the Russell 1000, which is in line with the S&P 500, just a little bit shy of 5% there. So definitely a strong week across the board that I'm looking at for the U.S. equity market.
Yeah, I was thinking that people try to ascribe a lot of like the strengthened equity market just as the election results, and certainly that's part of it. But also, I think that so much of it, right, let's say over the past 2 months since kind of the Fed meeting, everyone's like, I don't want to do anything ahead of the election. It's so much of an unknown. It was such a coin toss, or people thought it was going to be a coin toss going into the election. Some of it's more of a a relief rally. Okay, we've gone through this vol point, and that we can kind of see what's going to happen from here. You don't have that huge unknown out there, so I think that's a lot of also the kind of strength that we've seen in the stock market.
Yeah, I think there's just a lot of pent up emotion out there in terms of people wanting to have acted before this, but like you said, there's just too much uncertainty, and that's the one thing. One of the things, many things, I guess, that the markets don't like is just uncertainty. So some of that's out of the way. We still have to make sense of what the policy will be, in the new year and beyond. But it certainly seems like that 8% plus that we see on the Russell 2000s, they're participating in what they think will be a little bit less regulations in terms of some of these in some of these industries here that may benefit some of these smaller companies in the Russell 2000. So we'll see how it all plays out because, a lot of things can change, versus what people promise in the campaigns versus what they actually are able to enact. So we'll keep our eyes out on that for our listeners here. And then moving on to the fixed income market, starting with treasuries here. Taking a look at the 2-year note, there's a pretty wild roller coaster week actually for rates here. I guess if you want to talk about it, the point-to-point Rip Van Winkle effect of not much going on, pretty quiet week. But on Wednesday, the day after the election, I was looking at the 10-year note, and it got as high as it almost had up to 4.5%. As we talk right now, it's at 4.3%, about 8 basis points lower than where it closed last week. But certainly, that knee-jerk reaction we had the day after the election pushed it pretty high. It had a lot of one-day momentum, let's say, there. But 4.3% where we stand right now on the 10-year. Moving out to the bond. The bond right now is at 4.5%. That's 8 basis points lower as well versus where we closed last week. And then going back other way around, 2-year note just for completion here, that's at 4.23%, about 2 basis points higher there, where it had closed last Friday. So the bond market like this. Right now, when I'm looking at the Bloomberg US aggregate, it's up about 80 basis points on the week-to-date basis. Year-to-date, it's up 2.25%. But again, similar to what I just described in the equity market, pretty much all the sectors that we look at here on DoubleLine minutes are in the green here. Leading the way are IG corporate credit. Not so much on the duration side, and although that didn't hurt, but I did see that the spreads really tightened over the week here. We're actually inside of 80 basis points as we talk right now. The spread for IG corporates, I see it at a spread of 75 basis points. So it's come in, a bit, about 8 basis points over last week, it looks like. Also here, emerging market sovereign debt performing well, up 1.5% on the week. High yield corporate credit up 1.3%, and then MBS agency mortgage-backed securities up over 1%. The remaining bank loans and U.S. Treasury markets each up about 50 basis points or so. So then when we move over to the commodity market also participated in this positive week here. It's up, just about 20 basis points right now on the week-to-date basis. So not enjoying it as much as the equity market by far, or, even the bond market, but 20 basis points higher on the week pushes it up to 4% positive on the year-to-date basis there for the Bloomberg Commodity Index. But looking at some of the underlying here, WTI crude oil back up in the 70 handle. Right now it's $70.17 for the front month futures contract of WTI. That puts it up 1% on the week. Year-to-date basis, it still has a negative sign in front of it at 2%. And then for gold, that's down 2% on the week, just shy of $2,700 a troy ounce, missing it by $4 flat right there for that mark there to get over that 2,700 handle there. But on the year-to-date basis, it's still up 30% for the week. And then for Jason Ferrant, his favorite asset or for favorite investment choice right here, he wanted me to give a little shout out here for Bitcoin. So Bitcoin, definitely enjoying it. Talks around the less regulation, or at least some clarity about how the Bitcoin will be treated in terms of potential or as a financial asset. There, it's up 10% on the week. Just off of its high that I see that it reached yesterday. Right now it's at 76,444. The high hit yesterday was just shy of 77,000 a coin. So definitely within spitting distance of that. So we'll see how the rest of the year holds for all these various assets. But right now it seems like financial markets are liking what they heard this week. Jeff,
I would say it was a pretty quiet week from the macro perspective, right? We had ISM services on Tuesday, came in at 56.0. Was the estimated was 53.8, so a pretty big beat there. It's the highest print since July of 2022. So if you kind of look at the economy, services remain very strong. We Thursday, we had as usual the jobless claims data. Initial jobless claims came in at 221,000. Was estimated to be 222,000, so right in line. Continuing claims 1.892 million. Was 19,000 over the estimate of 1.873. So a little bit hotter than expected, hotter than last month on the continuing claim side of things, or last week, sorry. It's kind of a new local high. But really, what we kind of like to look at the 4-month moving average. It's been on the rise for 5 consecutive weeks, but not really at a level where we are concerned yet. But obviously, the trend of rising for 5 consecutive weeks is not good. Obviously, also on Thursday, we got the FOMC rate decision. We'll talk about that in the topic of the week here in a minute. But the Fed did cut 25 basis points as expected to 4.75 is their the bound now. And then this morning, we did get the University of Michigan inflation expectations. Those continue to remain, or it's a 3.1% up. It was expected to be 3.0, was 3.1 last month. So no unanchoring there from the inflation expectation side of things. But really, from a macro side of things, it was a pretty quiet week. If we do look at where the market is pricing in future interest rate cuts, we're at 68% of it for a cut in December. And we're still priced in kind of pretty much the same as last week or last couple weeks. We have 3.4 cuts priced in between now and the end of 2025. So not really too many changes there from a market perspective. And if we kind of get into the Fed here, Sam, it was really, everyone knew. I think Eric was on the desk yesterday, and when we were looking at it, we were like, oh, it was 99.8% chance of the Fed cutting 25 basis points. And, given the bid ask, that's pretty much 100% chance. And the Fed delivered as expected. It was a unanimous decision. So I think Bowman last month was the one that, or last meeting was the one that dissented. And it was a unanimous decision here on this meeting for that 25 basis point cut. So really nothing to see from that side of things. Everyone was kind of looking forward to seeing what Jay would say in the press conference, because everything was kind of chugging along here as usual, and really we're at a place where trying to get some forward guidance, trying to get some sort of ideas of what the Fed is looking at, what the Fed is thinking, was really the important part of this Fed meeting this time.
Yeah, I agree. It seemed like he did want to just kind of keep it almost a script, and it's we definitely know he prepares for these things, right? But we made mention of the fact that I think for the first question, which was thrown out, it was something related to the election, and Powell actually just not only stuck to script but read from a script. We just saw him looking down the entire time and reading it. So that was something I hadn't really quite noticed in the past. So I think it was. This press conference was designed to not make any waves, as if as much as any other one. But it just seems like this one was he wanted to nail it down.
Yeah, and normally you can kind of see. I think he knows, or what I understand or what I've heard, and I think Jim Bianco is the one that kind of has mentioned this in the past, and why I've kind of tried to notice it is that he knows, they do the research and what the journalists are writing, so they kind of know what tack they're going to come up with or what kind of questions they're going to ask. And you can kind of see, sometimes they cut away too fast, but sometimes they'll be like, okay, we're going to call on, Nick. They go Nick Timros and Nick's next. And you can see Powell flipping through the pages or flipping on the iPad, depending on whether he's going high tech or low tech. But flipping through the pages to kind of know what kind of information he wants in front of him. So when he's talking about inflation data and all this information, he kind of already has, I wouldn't say a script, but he has some bullet points on what he wants to hit. And I think that they kind of kept, you could see him looking down more this press conference. So maybe he was doing more old school paper flipping as opposed to the iPad, which is a little bit higher. So he kind of looks like he's looking at the people more. But it was interesting that he was kind of sticking to the script much more this time.
Yeah. I mean, there was one thing that I think he didn't really need a bullet point for, or at least if it was a bullet point, it was just a single word. But he did say no a lot in terms of his entire answer for a number of the questions regarding the new administration and the new president coming in. So
yeah, we'll get to that. But I was thinking when I was looking at it. We always know that the meetings that are not on the quarterly schedule, so that we don't get dot plot. One of the things they were asking about was like, what is the committee thinking? He's like, we don't fill out an SEP, and I can't speak exactly to where the committee is. I would say for December, we're going to be, again, in every meeting, we're going to be looking at the incoming data, see how that affects the outlook. They're recalibrating their level. They're still he thinks that they're still fairly, or they were fairly restrictive at the 533. They moved down 75 basis points now. And so is that where they need to be? Do they want to keep moving down? They're really looking at the idea, that there's the risk of moving too quickly. And he says perhaps undermining their progress on inflation, or obviously the other side is moving too slowly and allowing the labor market to weaken too much. So they're trying to be in the middle path there where they can maintain strength in the labor market, while also enabling further progress on inflation. There was a question. Then the follow-up was like, okay, so we know you don't talk for the committee. What do you think? And he declined to answer that question also, as you kind of knew he would. I thought one of the interesting questions, and I haven't seen too much about it, was basically talking about what's happened to the market since the last Fed meeting. The last Fed meeting, the market's up 10 years up 65 basis points or so. Some of that is from longer term inflation expectations. If you look at the 5-year inflation break evens, that's up about 50 basis points. And does Powell have any concern about longer term inflation expectations de-anchoring or anchoring at a higher level? And Powell's his response to that question was they're not seeing inflation expectations anchoring higher. They're still consistent with where things are moving, but still consistently around that area. So Powell doesn't think a 50 basis point move or 65 basis point move is really changing things too much. I think that bond market investors would beg to differ with that. But really, he thinks that things are still pretty consistent with a 2% PCE inflation. So I think he's building himself some cushion there, not necessarily 2% right away, but I think he's looking for 2 to 2.5. So that 50 basis points doesn't mean too much from what the Fed's thinking. And that was really my big kind of I would say market or takeaway from like the Fed policy. They're still focused on inflation. They're not leaving too much into the short term idea. I saw some comments that were saying that he thinks that this move may be transitory, but obviously he doesn't want to use the transitory word. That's a banned word now from Fed chairs. But really that, I guess longer term view, whether the market kind of comes back down or kind of stays at this higher level. And then the Fed will have to worry about it a little bit more.
Yeah, it's definitely become the 4-letter word amongst FOMC or central bank lexicon there as well. But he also, continue to put out the message that, talking about the new banned ideas is just this autopilot idea as well, right? Just data dependency, no clear path in terms of what they're going to set forth with monetary policy. And, there's a lot of data even between now and December that could move the needle here. So he did pick up a little bit, and some people are making I think it might be making a little bit too much of it. But, as he was speaking in the press conference, he did make mention of that the latest inflation report, and then, here it would be PCE, was a little bit higher, than he had expected. But, it's one print. So
we'll see how it goes. He said it wasn't terrible. So I guess that's the bar now is terrible. And then Sam, another T word. As you said, Sam, kind of the kind of highlight, and everyone was laughing on the trading desk about this was he got asked the question, and I'll quote it. It was like, some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you? Chair Powell just said no. Then she followed back up. Can you follow up on this? Do you think that legally that you're not required to leave? He said no. And then, a couple reporters later, and it was Politico was asking those questions, and those are only two questions she got. Those are the two answers she got. So she got the shortest answers, for two questions ever. And then there was a follow-up question later on, and Powell was asked, do you believe that the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions? And Chair Powell just said, not permitted under the law. And, that was as close as Powell would get to the political side of things. Any other sort of question about politics, he would say, we decline to talk about politics. And as you mentioned, Sam, we're kind of waiting to see what the policies are actually going to be, or what the policies are planned to be. And Chair Powell did talk about how once they get the, policies out there, then they can put them into their models. There's no point in, just trying to guess at what the policies would be and putting them to the models. And so it was really I thought it was kind of interesting to talk about how they want to approach things, and how they have, their models that they want to guide things, and really waiting to see what would happen, whether it's tariffs or tax cuts, and how that affects whether it's inflation or growth. But really waiting for those actual inputs to go into their models before they can, judge the potential outcomes.
Yeah, and then he did, prior to that, if I recall correctly, he did make mention that, right now he just don't know exactly how the policy is going to evolve. So, they're going to wait for the information to come out from the administration. They're going to go and hit the books, from their massive amounts of research that they have on these various, potential policies of tax hikes, tax, cuts, depending on which sector they're for, what the tariffs mean, and, it mean for various industries. And they're going to study that and then, apply it to the model. So it's good to hear that, but it's also good to hear that he's pretty much stuck to script, and it was pretty much a nothing burger, as we like to say around there for
Yeah, it was.
for the type of meeting, which is perfect for this week.
Yeah, we didn't need any more volatility from that.
Yeah.
Next week we do have some potential volatility, though. We do on Wednesday get we have CPI coming out. I guess it is inflation week next week. CPI on Wednesday estimated to be month over month at 0.2, core CPI 0.3. That would get the headline CPI to 2.6 and core CPI flat at 3.3. So, hopefully that's not a terrible inflation report. The next day we do get PPI final demand expected to be 0.2. Up from 0 last month. Core PPI at 0.3, up from 0.2 last month. That would put year-over-year PPI final demand at 2.3%, up from 1.8. And so that shows you how bad or how low PPI was last year at this point in time. And then PPI ex food and energy year-over-year at 3.0, up from 2.8 last month. So kind of keep an eye out there to see how those obviously go into the PCE as we talk about every month, and see whether what we expect the PCE or what the market expects the PCE to come from there. Get jobless claims on Thursday. Initial claims are expected to be 225, so flat. And we don't have an estimate out for continuing claims yet, so we'll see whether that upward trend continues. And then we get on Friday kind of the bigger number, see whether the consumers continuing to prop up the economy. We got retail sales expected to be 0.3, down from 0.4 last month. The ex-autos and gas, similar at 0.3, down from 0.7. And the so-called control group also 0.3 from 0.7. So I guess I could have summarized it pretty easily by saying all three retail sales numbers we look at, all at 0.3 expectations.
Yeah, that's right. So it's pretty much, I guess, the second to last for the year print that we'll have in terms of the monthly data that comes out. So we'll see what the next two hold with regards to the American consumer and the holiday shopping season.
Yeah, it'll be interesting to see. The corner. Yep. Well, should be starting. I got our those of you that are not on the trading desk, and that would be most of you. I got mad at Sam because he was trying to start to play Christmas music already. So
I was already thinking about my playlist and which ones would annoy you most were the ones I was going to put forward as the first two.
As you were wearing your Christmas socks.
That's right.
All right. Well, that wraps up for this week. I'd like to thank everyone for tuning in.
Yeah, thanks everyone for checking this out here today on the Minutes, be it on the Spaces or on the YouTube that we have now. Don't forget, Jason Ferrent and team do a good job of putting on the charts for some of the data that we talk about here on the YouTube, and you can find that on the timeline there as well. So, for those of you who want to see some schematics or some pictures, as I like to call them, behind some of the data that we're talking about, you can find it on our YouTube channel there. But don't forget you can always send us an email at minutes@doubleline.com or on the Twitter, on the X, I guess, at DLine Minutes, if you have any questions, comments, or suggestions for future topics that we can hit up here on the Minutes for the topic of the week.
And we did get a question from Rich, and I think you're out next week, Sam. So I think me and either or Mark or Eric and I will cover that. Sam kept on mentioning our YouTube there. It's youtube.com/DoubleLine Capital. Our team has done it. It was very fast. And, Jeffrey was on TV yesterday on CNBC post-Fed, and it's already up on the YouTube. So if you missed that, check that out. We should have some people on TV next week. We got Ken Shinoda on Bloomberg's The Close at 12:50 p.m. Pacific time there on Monday. Robert Cohen will be on CNBC at 10 a.m. Pacific time on Tuesday. Jeff Sherman will be on BBC News. Catch that one on the replay because that's the 6:30 a.m. Pacific time one. And that one's typically pretty short, so that's a good replay one. And then Jeff Sherman could also be on CNBC on Tuesday. So keep an eye out there. Keep an eye out on our YouTube so you can catch those replays if you don't catch them live. So I'd like to thanks for tuning in and hope everyone has a great weekend.
Yeah, thanks everyone, and good luck out there.